I feel like today's episode is about like a James Bond villain named, you know what I mean? LIBOR?
Well, it is English, so it would work. It's where it originated, so that's fair.
James Bond. Allow me to introduce myself. I am
LIBOR.
It sounds so evil.
Evil. It had a purpose.
Yeah.
It has a purpose. It still does. It's for at least a short time period up in here until 2021.
In the new episode of Uncommon Solutions, we're talking about the mysterious sounding but also very important benchmark lending rate called LIBOR. LIBOR is going away, and that will have some implications on certain insurance strategies like premium finance. So first, I'm going to check in with John Brady to better understand what LIBOR is and why it's important. How impactful is LIBOR on the whole world of lending?
Probably the most impactful rate there is at this time. It's, it underpins close to $200 trillion in financial instruments in the United States alone.
You just don't know it, right?
You just don't know it. Your auto rates, everything that you could potentially look at, I guarantee you there's a product that's tied to it.
It sounds more and more like a bond criminal to me.
Yes, absolutely.
So I guess to sunset that or get rid of it, that's a pretty big deal.
Yes, it's a very big deal that LIBOR is going to be going away. It's been with us since 1980, and it's really become a very, very big integral part in the financial system.
And LIBOR matters a lot to agents who sell premium finance strategies, the practice of strategically borrowing money to fund large insurance premiums. Andrew Dean joins us to talk more about the impacts.
I've been learning a lot about what you guys do over there, and I know you spend a lot of time and thought in trying to, essentially protect your clients from fluctuating interest rates. And so let's talk a little bit about how that's done and how it links to LIBOR.
Yeah, it's a great question. So a lot of our clients, some are comfortable taking on floating rate risk, some are less comfortable. So at the end of the day, it definitely is a client decision. And our general philosophy is that we want to make sure we kind of protect that arbitrage between the insurance crediting that you're getting versus the borrowing rate. And so at the end of the day, we're buying a derivative, which is basically a financial instrument that is used to hedge against risk. And so we're buying three types of derivatives typically in the marketplace. We're either buying an interest rate cap, which is just capping the amount of interest that you can pay. You get to enjoy the lower interest rates, but you get to cap at least the max amount you would have to pay. There's a collar, which puts on a floor and a ceiling on an interest rate. So you're going to fluctuate in between those two bounds. And then the third one is just it's called the interest rate swap. And essentially what you're doing is you're swapping a floating rate for a fixed rate. So instead of kind of that variability, you're actually going to go get a fixed rate essentially.
What's going to replace LIBOR? How will it work? And how will it impact the world of premium finance? Hear that and more on the next episode of Uncommon Solutions.